Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So as usual, I like to look around and see some of the dividend companies that are out there that are undervalued at the moment, and I found 6 for today's video. So I'm going to share with you guys those 6 different companies. These are well-established companies, they've been around for quite some time, they pay excellent dividends. And what I would like you to do, of course, as always do, is basically to do your own research, because in the end of the day, I'm human, I can make mistakes, and I'm just sharing this with you guys as a bit of entertainment and just to kind of get you guys start thinking about stocks and so on, what to buy. All 6 different companies are Sharia compliant, so you just need to do your research, inshallah. Before we start, just starting with a bit of a market kind of news, if you like, and just looking at the fear and greed index, it looks like we are heading towards greed again, and I would not be surprised by the end of the week we're here somewhere and potentially moving towards extreme greed. And the reason I say that is because I don't know if you've seen the news last couple of days, GameStop and AMC are back. And when I say are back, it's just to look at how much these companies are up just this week. 90%, and that's just basically yesterday, and I think Friday, or basically if not, it's just yesterday. This is really a bit concerning. The reason this is up so much is because some guy came back from the dead, the guy who drove these things when it came to GameStop, the meme stocks if you like, in 2021 and so on. The roaring kitty guy has come back apparently, and for that reason people got excited about it and they start buying this stock like crazy. So it's up 90% just yesterday, or basically last 2 days. Looking at the same thing again with AMC is exactly the same, 50 something percent just yesterday. 78% yesterday. For the 5 days is about 50, almost a 60% up. Now you really need to be careful. Don't get caught up with all this madness. This is to happen before in 2021, and we all know what happened in 2022, where this guy disappeared and all of this happened, and there was lawsuits after whatever, and then there was movies made about this guy and all sorts of million things that happened afterwards. I watched all of that unfold, and I've seen a lot of people lose money. And if you don't believe me, watch this. Okay, so year to date, this company is up 82%. It's not up 82% because the company has a massive product. It's got AI or anything like that at all. Look for the 1 year. Okay, it's basically gone up quite a lot for the 1 year. But when you look at the last 5 years, in fact, let's just click max, and we're gonna click the top there. Someone bought it, this stock basically when it was $81 per share. Guess what happened to that person? Right now they're losing 62% of that money right now as we speak. And the chances of this thing going back to 80, I'm not sure. I've seen it go crazy. But look at this. Look at this. Even if you just click the last 5 years, is over 1,300%, which is absolutely ridiculous. So you guys really need to be careful. Inshallah, I'm sure none of you guys will be interested in something like this. But look at this one again. From there to the bottom right now, 97% down. Someone bought it when it was, what was the price? $230. And right now we're looking about $5. This is ridiculous. So please be careful, please be mindful. When it comes to like fear of missing out, people are like, oh, maybe I can put this much money. I don't even know if this company is Sharia compliant. I'm not interested. I'm not going to look at it. AMC, I'm sure is not, because it's the cinema, right? And GameStop, I don't even know what they sell. I think they sell games, old games or whatever. Anyway, be mindful, be careful, please don't fall for these kind of things. Stay boring, stay consistent, and focus on the long term, inshallah, and you will be fine. If you have not joined us on the Patreon account, please do so. It helps the channel. You can see all my buys and sells, all the division trackers, as well as the Discord full of brothers who are sharing really good practices, mashallah. Now I'm gonna go over these 6 companies that I've mentioned. Okay, I'm gonna give you a quick overview, and as always, please do your own research to find out more. Now, talking about the first company is J&J. J&J is one of those companies that I have in my portfolio. Currently have 361 billion market cap, wide economic moat. current price is $151 per share. Dividend of 3.3, which is quite nice for the first time. Payout ratio 46%, latest increase of 4%, and the 5-year growth rate of 6%, which is nice. They have increased this dividend for 61 years. They will give you almost $5 for every share of this company that you own. 99% safety, profit margin almost 20%, return on equity 23%, 24%, return on invested capital 22%. Free cash flow $80 billion and 6% return in total return in the last 10 years. This is one of the reasons I really like this company. Is a kind of predictable business. They have excellent free cash flow. Their margins are always good. We'll see what happens because of the Kenvue spin-off. We'll see what happens because right now they're just focusing on the pharma side of things. So it will be interesting to see in the next few years. Growth estimate for next year is only 3%. After that, 5% every single year, which is what you expect from this company. Right now, discounted about 9% according to Morningstar. $164 per share is where they think the price should be. If we go to Seeking Alpha and look at the predictions for the estimate for the next couple of years, earnings estimate, as you can see here, 7% this year, then about 3%, 4% after that. When it comes to revenue, about 4%, 2%, 3%, which is basically what you expect from this company. In terms of Wall Street predictions, price-wise, you can see 7 strong buys, 4 buys, 11 holds, and that means the company is now trading about 14-15% upside from downside from it's got 14% upside from where we are right now. So yeah, it's nothing huge to worry about in terms of the business. A very predictable business. So we'll see what happens in the next couple of quarters. Next one is Nike, one of the companies that I'm sure you own their trainees or tracksuits or things that these company sells. $137 billion market cap, wide economic mode. Current price is $92 per share. It's been hovering around here for quite some time now, and there's a lot of headwinds for this company. So it'll be interesting to see how they maneuver around that in the next few weeks or months to come. Dividend yield is only 1.6%, payout ratio only 40%, which is about 39%, which means they have room to increase that, and they are increasing about 9%, 11% for the last 5 years. Dividend streak of 21 years, so the 4 more years will become dividend aristocrat. Payout ratio, annual payout, $1.48, safety 99%, profit margin 10%, return on equity 36%, and return on invested capital of 21%. $6 billion of free cash flow right now, about 11% total return in the last 10 years, 5% growth estimate next year, then 13% after that, 30% discounted right now, $129 per share is where they think the price should be. So if we go on here just to have a quick look, you will see in terms of earnings expectations, okay, double digits in this year in terms of EPS side of things, and then 6% double digits, 7% double digits again. And then you're looking at, this is probably the reason why they actually are trading very cheap right now, because they're expecting nothing from this company this year. Again, remember, these are just the estimates. Okay, this is about 2% from in 2025. 2026 is better, about 6%. And then 2027 is again another 6%, another 6%, another 6%, all the way down. But if you just want to focus on the first 3, you can see things will improve as we go along. So nothing huge to worry about in terms of Nike. Next one is Sanofi. This is a French pharma company, pharmaceutical company, $127 billion. Wide economic mode, $50 per share right now. Dividend yield of 4%, which is really good. Payout ratio is only 50%, and the latest increase was 5.6%. The 5-year growth rate of 4%, 24 years of increase in that dividend. Annual payout right now is $2.04. Safety 90%. Profit margin of 12%. Return on equity 7%. Return on invested capital of 9%. And then $7.8 billion of free cash flow right now. Total return in the last 10 years, 3%, which is absolutely rubbish. Growth estimate next year is about 18%, and then basically 9% after that. 19% discounted right now. $61 per share is where they think the price should be. And looking at their earnings expectations moving forward, as you can see, about flat this year. That's probably why it's down a lot. Then about basically 16, 17% there. Then 6% when it comes to revenue, 7%, 8% kind of thing. So nothing huge to worry about in terms of that company either. Now looking at the ratings, let's go to 5 strong buys, 2 buys, 2 holds, and about 16, 17% upside from where we are. And the next one is automatic data processing. This one is only fair valued, so I'm sure it will come back down at some point in the next few weeks if the markets come down. But it's about 240, and here is about 247, so not much of a difference. But again, is one of the companies that I own, over 100 billion market cap, nice dividend right now, 2.27. Payout is only 56%, latest increase 12%, 5-year growth rate of 14%, which is really nice. They will become a dividend king very soon. Annually you will get $5.60, safety 97%, profit margin 19%, return on equity of 88%, and return on invested capital of 61%. Excellent free cash flow. Growth was really good in the last 10 years. Growth estimate for next year is about 9-10% for the next 5 years, which is wonderful to see, and it's only fairly valued at the moment, which is nice to see. And I really like this company. Is one of the companies that I've had in my portfolio. Would like to buy more of it. According to Wall Street, they're saying it's 2 buys, 1 hold, 14 is basically hold. So interesting to see that they've actually voted for hold. But again, even then, it's the about 4-5% upside from where we are. $259 per share is where they think the price should be. And in terms of estimation moving forward for this company, for the earnings side of things, double digits, almost double digits every single year for the next 3-4 years. And when it comes to growth side of it, it's about 6-7% every single year, which is nice to see. We've got 2 more to go. Next one is one of the REITs. This is the landlord of basically Amazon, Prologis. This is one of the companies that own majority of the warehouses Amazon uses. $99.5 billion. It doesn't have any moat. Price right now $107 per share. Dividend yield of 3.57, which is quite nice. Payout ratio is 71%. Remember, REITs do have 99% almost, and up to 99% when it comes to the payout side of things, because they're expected to pay that majority of their net income as a dividends. Latest increase is 10%, 5-year growth rate of 13%, which is really nice. They've increased this dividend for the last 10 years. Annual payout $3.82, safety 61%, profit margin almost to 39%, return on equity 6%, and return on invested capital of 4%. Free cash flow right now $5 billion. Total return the last 10 years 12%, which is really good for a REIT. Growth estimate next year 18%, then 6% minus 6% after that. But then that can easily change if interest rates do change. Of course, more people will start buying properties, and this company can then go to the bank and get basically a loan to actually build more warehouses and for cheaper prices basically. So that can easily change. So if interest rates come down, REITs will perform better. So, okay, 10% discounted right now, $120 per share is where they think the price is, price should be. Now looking at estimates for the next couple of years. So this year is basically almost minus 3%, and then after that double digits, which is really nice to see. And then when it comes to, that's by the way FFO, and then this one here was 11%, 9%, or 10% almost, and then 13% after that. So there's nothing to really to worry about. The revenue is still growing. The EPS is slightly declining this year, and that's why the stock is down quite a lot. In terms of ratings, let's click Wall Street. So 10 strong buys, 8 buys, and 5 holds, and that means the stock's right now about 23% upside from where we are. $132 per share is where they think the price should be, and for these guys is about $120 per share. Finally is Kenvue. This is the spin-off from J&J, so they have all the consumer products in this company through 39 billion market cap, wide economic moat, $20 per share right now, almost 4% in terms of dividend yield. Payout ratio is 49%. They don't have any history, so that's why they don't have anything there. 8 cents is what you'll get for every share of this company that you own. Safety is 70%. Profit margin of 9%, return on equity about 9%, and return on invested capital of 14%. They have $2 billion of free cash flow right now. And when it comes to total return in the last 10 years, of course, you're happy they've only started the business very soon, recently. Growth estimate next year minus 12%. After that, they 9% basically for the following 5 years. They're expecting the earnings to grow about 9% every single year. 19% discounted, $26 per share is where they think the price should be. This seems really interesting. This is a very interesting company because it has all the consumer side of things. It seems very, very cheap, and the growth basically seems very decent. In fact, let's just have a look at what Seeking Alpha is saying in terms of. So we got 4 strong buys, 3 buys, 3 holds, 8 holds, and 1 sell. And that means, okay, about 10% upside from where we are. $22 per share is where they think the price should be. earnings expectations moving forward. Okay, so this year is almost basically a decline, then after that 7%, and then 4%, and then 4 something percent there, then 1% in terms of revenue side of things, 3%. So if you're looking for a steady eddy kind of company, basically you want to stabilize your portfolio because you want to like some of the consumer stables kind of stocks that will not rock the boat, that has a very low beta and so on, this will be an interesting one to look at. Anyway, that's the 6 companies I wanted to share with you guys. Please focus on the long-term investment. Don't worry about this AMC all madness that's happening. That's the Sharia compliance side of things according to Zoya. Have a look at that. Pause the video if you're interested in any of this business. And like I've always said to you guys, it takes a lot of time and effort to put these videos together. I would really appreciate if you can join us at the Patreon account where you get access to a lot of these things. InshaAllah. Have a wonderful day. Assalamu Alaikum.